Um, I hope everyone's had a good summer, just as we're going into autumn, dark mornings and dark nights, and with the budget looming. However, there is some good news on the horizon. One of those is some of the stock markets being at all-time highs, or close to all-time highs, which we'll touch on today. But I think it's safe to say with both Pareto and Luna's clients are asking what we think will happen, particularly going into the budget. We don't have a crystal ball, but hopefully we can share some opinions of what we think will happen going forward. We've also got the issue that we thought was over with Trump in China, starting a few more trade tariffs and hopefully not going into some trade wars. But there's positive news with Israel and the Palestine conflicts hopefully coming to an end. And it appears that most of the volatility that's in the marketplace at the moment is again geopolitical, and the fundamentals of companies are actually quite strong, which again we'll touch on later in the webinar. Particularly within some of the large and mega cap companies, such as the FTSE 100, and obviously the Magnificent Seven that we keep touching on. Currency remains an issue, with exchange rates eroding some of the investment returns, which is again quite high up in what our clients wish to discuss. But it's not all doom and gloom. The IMF stated yesterday that they expected the UK to be the second fastest growing economy in the G7. But on the back of that, they've also said that it's going to have the highest inflation, driven by higher energy and utility prices. So today we'll be sharing our perspectives on the current market conditions, investment strategies, and the impacts on clients' plans, and in particular looking at some financial trends and some of those market developments. For regular listeners, Alex and Chris will need no introduction. However, for people who might be tuning in for the first time, Alex is the Chief Investment Officer for Luna Investment Management, and he's responsible for coordinating the overall investment strategy at Luna. However, a bit of an accolade came out yesterday. He's been voted in the top 20 investment wealth managers in the UK according to Citywire. So congratulations, Alex.
Yeah.
Sadly, Chris hasn't. However, Chris
no
is
accolades for me. Yeah.
Chris is a chartered financial advisor, sits on the Pareto Investment Policy Committee, specialises in working with individuals, owner-managed businesses and accountants. So today we'll be looking at the overall view of the markets and the impact this has had on clients' portfolios. We'll be having a look at some alternatives to equities. As I said, they are at the all-time highs, and also an alternative to cash. So we'll touch on gilts, which I know you've been speaking about for the last 12, 18 months, Alex, and the benefits of those. We will be looking at the impending budget and impact on investments and financial planning for our clients, and what clients can expect going forward. I'll reiterate, as I do in all of the webinars, it's important that our clients keep reviewing the risk and volatility, just to have a sense check to make sure their underlying funds are performing as they should be, and also reflective of their risk profile, which is transient and may move according to market conditions and personal conditions. Just a little bit of housekeeping before we start. If we can all make sure that we're all on mute, we should be, just to mitigate some background noise. The presentation is being recorded and will be available on various channels. And the presentation should last 40 to 45 minutes, and we'll have a Q&A at the end of the session. Any questions can be put forward to us in the Q&A button at the bottom of the screen. So moving on, markets are strong. We've discussed all-time highs. The FTSE, S&P, Eurostock, Nasdaq, Nikkei are near or at all-time highs. Alex, can you explain what's making the markets be so buoyant at the moment? And is there still volatility within the equity markets?
Yeah, so I mean, the main trigger has been really since April. So when we saw the Liberation Day announcement, we saw a really big shock in the markets because tariffs were being introduced and they were coming in much higher than the market had expected. But what you've seen since April is a number of trade agreements come through. You've seen, and not just that, but pauses put in place as well with certain countries like China. So the UK was one of the first countries to get an agreement, which looks a bit of a coup now and probably has helped the UK economy to a certain extent. I think we'll talk about politics in a bit more detail later, and maybe I'm not completely positive on everything that's done, but I would have to say that that's definitely a positive. But you've since seen agreements with Japan, the European Union, other major nations, and that's been really key because it's removed one of the key geopolitical issues that we had coming into this year, which was trade tensions. That not only that, you've seen company fundamentals still performing well in this environment. You've seen earnings resilient, companies doing well, and they've weathered the storm of these tariffs very well. Whether that been pre-stocking beforehand and getting ahead of things, because let's be honest, it was known that this was going to happen coming into this year as well. It's one of the things Trump talked about it. But as I said, it was just the shock of the extent of it. So global growth remains strong everywhere, but we're seeing a bit sluggish growth in the UK, but it's still positive. So you're in a backdrop of global growth being strong, inflation largely under control, and what we're moving into next year is interest rates probably continue to come down, and maybe towards the end of this year as well, which again is a stimulus to the economy because it stimulates more money to be released from banking systems into the economy. On top of that, you've got the US fiscal bill, one big beautiful bill that Donald Trump's announced, which again should be positive for growth as we move into next year as well. So there's been a variety of reasons, whether it be, as I said, trade agreements starting to be done, wars coming to an end, geopolitical issues coming to an end, companies performing well, and just growth being quite resilient. I think the risk is that, as we've seen now, Trump can change his mind and tweet at any one time. And we saw this on Friday when he started to say that he could introduce another 100% tariff to China, which was completely out of the blue. And China aren't as reliant as they were on the US now than they were when he was last in office. And you can definitely see that they're going to retaliate back. So we've seen this before, the two greatest superpowers in the world going head to head in trade. It's not a positive for anyone, and that's what's been giving people jitters, particularly as markets have done so well over the last 6 months or so.
Okay. And you said markets are resilient. The markets actually don't mind bad news, do they? They love good news. What they don't like is uncertainty, because with bad news, they can't plan for it. They can model it through. Good news, obviously, is fantastic. They can model it through, and you get the positive emotional effect of it as well. However, they don't like that uncertainty, and that's where the markets may be a little bit fragile.
Yes, I mean that's what the tariff announcement did, because we didn't know the tariff was going to be 10%, 20%, 50%, or 100%, or whatever. That was the uncertainty for companies, and individuals and businesses couldn't plan in that environment. Now we've got certainty. I mean, it's been the biggest tariff increase for 100 years, and markets have been quite resilient on the back of it.
Yeah, good. And Chris, with regards to the impact on portfolios, obviously portfolios are high. What should clients be thinking about when we're reviewing their portfolios on a 6 monthly, 12 monthly basis?
Yeah, I think now's kind of a better time than ever, really, to have a bit of a review. Just the worst time to start thinking about, am I at the right level of risk? Is when things are going wrong, because I think emotions can be a bit heightened. So sometimes when things are doing well, it's a good time to do a bit of a lifeboat drill and go, well, how would you feel now if actually we did have a pullback? Because it's perfectly normal for markets to have good spells, but then fall back a bit, and we've seen that in a perfect kind of nutshell over the last year. Effectively, we've had on a 1 year figure, pretty decent growth, close to 10%, but it certainly wasn't like that in a straight line. We had a big fall in April and the big bounce back. And now that we're back at those highs, it's a good time to say, well, how were you feeling during that period? Were you close to feeling like you would want to pack it all in and move it to cash, or were you comfortable with that? And that's often a good sign as to whether you're in the right portfolio, because if you did, no one really sits through it and enjoys those periods, but if you felt comfortable, then you're probably in an okay risk profile. If you did feel a bit on the edge that that was close to being too much, then actually maybe you're not in the right risk profile, and maybe you should be in slightly more defensive assets. So I think now's good time to be reviewing that, because we've got a fairly recent market event to go, well, how were you feeling through that? If you missed it all and didn't check your portfolio during that period, then great. But and I think the other element to it is, you know, again, I speak about this often. What's your kind of upcoming potential cash needs or withdrawals needed from your investment portfolios? If you are still 10 years away from likely accessing your funds, then you can pretty much ignore short-term volatility, and you'd be saying, really, you don't need to be making too many adjustments. But actually, if there's you know, some cash needs coming up, repaying a mortgage, obviously we've got, you know, lots of clients who might have been on longer fixed rates from just before the rates went up, and coming to a point where, you know, they might want to chip some off the mortgage. Well, actually, now's not a bad time to say, well, if in 3-6 months you might need some of the cash, we're at all-time highs. Let's start to think about earmarking that now, because it's better doing it now than, you know, had it been needed short-term in April.
And also people who may be taking an income, bank the next 18 months worth of income. You can still get 3-4% on some of the cash rates out there, and we'll touch on in Gilts, but just bank the next 18 months and say, markets are high, I know I've banked that, I've got nothing to worry about for the next 18 months, 2 years.
Yeah, absolutely. We would always say to clients, make sure you have that cash buffer built in, especially if you're at the stage of drawing down on your funds. You know, you don't want to be fully invested at that point, and having a diversified portfolio is key as well. You want to have the ability to, you know, if you know, because you can't always time things perfectly. Life has unexpected changes, and we don't always get, you know, 8-12 weeks notice for when cash is needed, and being able to have different options to draw it from, which is either, you know, if it's a full portfolio that you can draw from the more defensive assets in times like back in April, or the assets that have done well now, or just, you know, portfolios at different risk profiles, kind of using a bucketing system like what we would do. You know, that can help balance those risks.
But I know, Alex, we were talking yesterday and you showed me a graph about the returns the 12 months after the market high, and the actual returns are still quite great. So if people are worried about the market being a correction, when there is a market high, usually there's still good returns to have in the following 12 months, 2 years, isn't there?
Yeah, I mean, hitting all-time highs is a positive thing, because it means there's a momentum in the market, and it means as the economy's performing well, and things don't just deteriorate very quickly. COVID being exception to that, because it was an unexpected event. But markets tend to deliver quite strong returns over the long term. Kind of 3/4 of the time, markets are positive. So, I mean, it might be worth just sharing that. Do you want to share that slide with you now, and we can show it on screen?
Of course.
2 seconds. You're going to give a bit of a glimpse into the other slides here.
I mean, I had a client that I reviewed this week, and we reviewed his portfolio, and we did a bit of rebalance at the back end of last year, and going into March, obviously with with Trump coming in March and putting some of his tariffs, his fund dropped by 12%. And so he was turning around going, I need to come out of the funds that we've rebalanced, that we switched to. And just with that little bit of education, we're saying it's probably the wrong time. Just stay in the market, have confidence in it. And the markets would, well, they were back to where they were pre-March levels by what, June?
Yeah, no, the rally in the second and third quarter has been pretty impressive. And you touch on trying to time the market, and if you did come out of all-time highs, well, there's been 32 for the S&P this year, and there's been 30 for the FTSE 100. So I'm not sure which all-time high you want to exit at. So this chart, this is done by Schroders. It looks at US markets. It goes back to 1926. And on the left-hand side there, it shows the returns 12 months after the market hit an all-time high. So you can see there 10.4%, whereas the average return in a year for markets is just over 8%, which is what we'd always say. So yeah, it's pretty encouraging to see that when markets are high, you do tend to see fresh highs. And so we're pretty optimistic. And as I said, if you're thinking about the fundamentals of markets as well, things do look pretty strong going into next year. But you know, corrections are always possible and very healthy, because markets never go up in a straight line, and you know, just taking a bit of profits, like you touched on, is a perfectly natural thing to do. And if everyone in the market's doing that, you're going to see the equity market fall. So no, absolutely, we'd expect a correction at some point, but it would more likely be a correction than a sustained bear market.
Great. So that's the markets, that's looking at equity return, but also one of the big issues on the agenda. People are talking about stagflation, people are talking about what's going to happen with interest rates. The IMF yesterday said about inflationary rates. We've got cash deposit rates that are probably quite stagnant as well at the moment, all around 3.5% to 4% in terms of the 6 month, 12-month, 2-year, 3-year, 5-year returns. In terms of what can clients expect from interest and savings, mortgage rates, inflation rates, what pressures do you think there are out there, Alex?
Yeah, I mean, stagflation is the appropriate word, and it's something. So, just to explain what stagflation means, you get accelerated levels of inflation and weakening growth, and it's what central banks hate. The central banks have got a dual mandate to get the economy going, as in keep the economy growing, but also to control prices and inflation. And if both are going in opposite directions, it's like, well, which one do we try and fix? The stagflation, it is here. We can see it in the UK. CPI is at 3.8%. The UK economy is growing below trend. So the UK economy is growing about 1%. It should be growing at 2%. It's not just the case for the UK though. The US is in exactly the same situation. Slapping tariffs on all goods into the US is going to be inflationary, and it has been. And it's also weakening growth because suddenly you can't go out and buy as much, or you've got concerns about going out and buying goods because you're not sure if it's going to be cheaper in a week or 2 weeks or whatever. So it's definitely stagflation in the UK and US. But what you're seeing is central banks are still easing because I think they're more worried about the risks to the economy than inflation at the moment. And if you go back to where we were in 2022, the central banks were worried when inflation was in double digits. Today, we're talking about 4% or 3% in the US's case. So it's largely under control.
And inflation can help us get out of the deficit that we've got against GDP, with just £2 trillion that's sat there in debt. So we can inflate a way out of that slightly, can't we?
It can, yeah, because the debt pile is static and inflation going up means the overall economy is growing more. So it can. It's just not a situation you want to be in, as you saw in 2022, because other things like gilts linked to inflation, but then they're going to be, the debt payments on them are going to be higher because the fact that the inflation figure is higher as well. So that means that your servicing cost is going up at the same time. So what do we think central banks are doing? Well, we've seen 3 cuts from the Bank of England this year, and we always said it would be quarterly. So February, May and August. The next possible time that they will cut will be November. I think it's 50-50, whether they cut in November or not. Wait and see how things go. But, you know, inflation at 4% and the economy kind of being a bit weaker, I think the government will want them to cut because it'll stimulate the economy a little bit as we're going into the budget. In the US, I mean, that's been a complete about turn. The relationship with Donald Trump and Jay Powell, the president of the Federal Reserve, has been pretty rocky to say the least. Because Trump is also putting pressure on the Federal Reserve to cut interest rates because it stimulates the economy and he wants a strong US economy. And the Fed have been not cutting interest rates because of the fact that inflation's higher, but they did cut in August. And there's an expectation now that they cut again twice this year. So interest rates are coming down. What does that mean? It means it's cheaper to service debt because your mortgage costs, your credit card costs, etc., are all linked to interest rates. So that's a positive, and that's why it's stimulative for the economy. But as you said, we're actually in a situation in the UK which we're cash rich. You know, people have been sitting on cash balances and been receiving a handsome interest. And for the first time for maybe 20 years, the interest that you've been receiving has been ahead of inflation. So in real terms, we've all been feeling wealthier. But that's about to change, I think, where cash rates are going to come below the levels of inflation. They're about the same now, if you think about it. Inflation's at 3.8 and interest rates at 4, so they're not far. And if interest rates come down a bit further, then it could change, which means that, you know, that this is what happened in that period from 2009 to 2022, when we were just in this low interest rate world and people were looking for alternatives to get a return on their investments. So again, that's probably a positive for investment markets as well, because, you know, people tend to think about bonds and equities when they're doing that.
So we mentioned interest rates. Obviously, you pay tax on the interest. So at 4%, if you're a 20% taxpayer, the net equivalent's 3%. At at 40%, obviously it's going to come down to 2.4 and even less if you're an additional rate. So Chris, there are alternatives out there to just putting your cash money into bank accounts, isn't there, such as Gilts?
Yeah, absolutely. So you know, we've been mentioning it in the last probably year or so in these webinars. You know, the way that Gilts work is, Alex could probably explain better, but I'll give it a go.
I'll get the chart up for you.
The chart helps, but you know, effectively they're priced at a gilt a year that's due to mature in about a year might be priced at 95p that will mature at £1. It's guaranteed to the extent that the UK government is still there in a year or hasn't defaulted, which, you know, despite what may come in the budget, I still wouldn't suggest we were going as far as that.
Nope.
But effectively, there's certainty in the same sense there is with cash that, you know, when that gilt matures, you will effectively get £1 back on your holding. The capital uplift from the 95p to the pound is capital gains tax free, and these coupons, these gilts that are used have, by their design, have very low interest payments. So that combination means that actually the interest, which is taxable, is very, very minimal, but the price movement from 95p to the pound is capital gains tax free. So for additional rate and higher rate taxpayers, as Alex is showing, kind of the equivalent cash rate needed to give you the same net position. When you look at kind of down those right-hand side, two right-hand side columns, if you look at the cash market now in terms of savings rates, you know, they're certainly not beginning with a 5 anymore, and a lot are moving into that 3.5, you know, down to 4. So there's certainly still opportunities for tax efficient ways of having cash-like holdings. But what I'd always say, and as you've touched on, Alex, you know, what we saw in the last 15 or so years was when cash rates were at nothing, you know, it really did push people into, you know, bonds and investing, which, you know, certainly did help the investment markets. But there is still an important need for cash and liquidity for clients and businesses. And it's you know, sometimes you just have to suck it up and accept that you're not getting as good a rate as you might have been recently, and that you may be going backwards in real terms with inflation, but it still doesn't mean you shouldn't hold cash at all, or you know, get pushed into the equity markets. You know, I say to clients that is there for a reason, and it's not to get the best return. It's there so that, you know, if it's needed at short-term nature, you can get at it. So yeah, there's certainly alternatives to cash, and I think you know, we've had a decent spell for the last couple of years where, you know, the cash rates kind of stayed a bit higher than inflation as it came down. But the hard thing is, you know, everyone's inflation is different. If you're paying school fees, your inflation's certainly been higher than 3.8%, and that's where, you know, it's easy to look at it on a big picture and say we're getting a, you know, thereabouts real return, but it's going to be different for everyone. So it really comes back to the planning of less about, you know, what's the return we're looking for on that. It's what's the purpose for that cash. Are there alternatives like gilts, which, you know, for higher and additional rate taxpayers that can be used? And also the benefit of gilts is, you know, there's always one that matures pretty much on the 31st of January each year, which ties in with the tax return deadline when people need to pay their tax bills. So sometimes it's good if you know you've got a tax bill coming up, you know, you can kind of earmark money in these gilts, forget about it, and then it will mature just in time to pay your tax bill.
Yeah, I mean, the only point I would add, completely with all that, is that gilts are very liquid. They're the most liquid investment in the market. So you can buy them and then sell them throughout the day. If you bought it today, then it settles tomorrow. If you sold it today, you get your money back tomorrow. So they're very liquid. Let's just go back to what's the risk? Well, risk in having money in the bank is if the bank decides to go under, like we saw in 2008. And by no means do I think we're in that situation right now. Financial regulation has been put in place to make banks extremely more safe following on for the financial crisis. But there's a risk there. The risk to buying gilts is that the government defaults. So, and again, I think that's just as unlikely. I know we have a lot of debt, and we can talk about having to raise more tax to pay for some of that debt in a minute. But I think that's equally unlikely as well. So
if it did happen, no matter where your money is, I think we'd all be in trouble.
Yes, I think we'd be getting baked beans out if that was the case. Yeah.
Great. And Chris, just on the back of that, I'd reiterate the importance of having the reviews at this moment in time. There are alternatives out there, and make sure you do have a well-diversified portfolio that reflects your underlying volatility.
Yeah, absolutely. As I mentioned earlier, it's always better to, do some forward planning now when markets are a good place, because if you are selling down from those to build up your cash buffer or whatever it may be, it's better to do it now than it would have been back in April. But yeah, it's at the moment it feels like a lot of conversations with clients come back to the budget. Either the last budget, which we're planning for the changes there, or talking about what might come at the next budget, which I know we'll be moving on to shortly. But again, it's a good time to step back and say we haven't got a crystal ball, although we'll give it a go shortly. But we haven't got a crystal ball, and you have to plan based on what you know, and what clients may hopefully will know better than what we know with the budget is what they might want to spend their money on in the coming years. So that's more important really than what Rachel Reeves may do. We can always adapt as necessary to those changes. But for us, it's, if we know what your cash needs are in the coming months and years, then we can plan for that, regardless of what Rachel Reeves might come out next.
And just wanted to say one further point from a Luna perspective. So we're rebalancing portfolios on a regular basis, and we did a big exercise in end of September, October, locking in gains from areas that have done well and reinvesting into other areas. And similar in April and May, when markets were lower, we were doing the same thing. So part of the active management that we offer and the discretionary powers that we have, that we're always looking to make changes and to keep the portfolio in line with the risk that it should be.
And you mentioned in the discussion that we had yesterday, Alex, about you made a decision, was about 18 months ago, to go into gold?
It was January. So,
January, excuse me.
Yeah, so it was early on in the year. First time in my career that we've ever bought gold.
Your long distinguished career.
My long distinguished career, 20 odd years. And the rationale behind it was because when Russia invaded the Ukraine, what the US and European Union did is they took all of the Russian assets in US treasuries and froze them. So it basically froze billions upon trillions of US debt that Russia owned. And I think that was a very important and sizable event, because what you've seen since then is other countries being worried about, I'm not saying a war is likely to come, but they don't want to have the risk of having their assets frozen by the US government. So what they're doing is they're selling down, or as their bonds are maturing, they're not reinvesting that money back into US treasuries. And that money has to go somewhere. They have to have their global reserves. And what we've seen from the statistics from the World Gold Council, it's a great website if you're interested in it. You can tell I'm a geek. But we go on and it shows who's buying gold, whether it's investors. But the big change over the last 3 years has been that central banks are buying gold. And as I touched on recently, they're price insensitive, because they have to buy it, because they have to have the reserves in gold. And what's happening is these bonds are constantly maturing, and so you're seeing constant flow. And then this year as well, because everyone started to wake up to this, it's not been the story for this year. The gold was up 30% last year, it's up 40% this year. What you've also seen is Donald Trump in trade announcements, and that's caused a flight, I'd say, from US assets, whether that be US bonds, whether that be US equities to a certain extent, but primarily the US dollar as well. So people are looking for alternatives, and gold has been in that sweet spot. And like anything, it's very difficult to just turn a switch and react to the demand that's coming through, as in, can you create another mine in the market? Well, that's blooming hard to do. You can't just turn a mine on to suddenly get more gold out of the ground. These projects take years to build. You need to get the financing. And because of all these ESG concerns that we've been living with for the last 10, 15 years, it's been politically unacceptable to put a new oil field or a new mine to get the resources out of the ground. So you're in a supply constrained world when demand is rocketing from central banks and investors. I think the investors are now starting to wake up to the fact. And back to what we were talking about with stock markets, when markets move to all-time highs, it starts to people start to wake up. Now, I've never thought I'd see gold on the front page of the BBC website. It was there last week because it went through $4,000. It's everywhere now, and that again creates another wave of demand. But I can't see this change. I mean, again, structurally, it's probably due a pullback. When it's up 40% this year, it's probably gone a bit too far, too fast. But longer term, these dynamics are not changing, so we're still pretty positive. And again, I mean, it's a safe haven asset that is there.
Default, isn't it?
Yeah, but to protect portfolios. And again, all these geopolitical risks that we've had this year as well, people are also looking for it to diversify. So, we bought it thinking, oh, we do 10 to 15% this year, it'll be a decent return. We're up at nearly 35, 40% now, and it's done well.
Yeah. So great, thank you for that. Chris, you mentioned Rachel Reeves before the budget, so let's get the white elephant in the room out a wee bit. I think it's safe to say no one really knows what's on the horizon. And she could possibly do anything. I personally, and this is my view, not company or investment committee, I think without being political, Labour in a position where in the polls they are far behind certain parties. So I think she will be quite pragmatic of what she pulls out. There's going to have to be a good rabbit out of the hat if there was something special that no one's seen. But in terms of your views on the market, Alex, how do you think the budget's going to go, and what do you think the impact may be?
Again, I like the slide. So let me just show this one slide to just explain the situation that we're in. I think it kind of, and it's probably the most depressing slide I've got. So I apologise if I'm making everyone a bit depressed on this morning. But looking on the left-hand side here, this is revenue versus spending, and it's scary, isn't it? I mean, we talked about a black hole this year, and we talked about a black hole last year. But what's going to happen longer term? We've got an aging population. We've got big pensions are going to come up. Healthcare costs go up as you get older. You've got a declining workforce, which is your revenue line. So what's going to happen? So this is a long-term structural issue that the UK and developed markets have. I mean, look at the problems going on in France at the moment as well.
Right.
So it's not just a UK specific issue, but it's certainly something that needs to be addressed longer term. And it's difficult to help because we're already at the highest tax take as percentage of GDP as we have been in terms of how much we're actually paying. And what we did last year was well, we're not going to take it from the individuals, but we're going to take it from businesses now. And that has an impact on the economy. So the business community has responded with unemployment starting to go up, employment starting to go down, which is bad for the economy, which means you then miss your GDP forecast for the year, which means you have this black hole to begin with. So it's almost like a negative cycle that's been created from the government in entirety. So there's something that needs to be done because you can't have these finances, and she's wedded to meeting the fiscal requirements. And that's important because, as we saw with the mini budget, if you don't meet your fiscal requirements and you try and borrow too much money, then the government bond market will respond, and that is important because then it increases your cost of debt, increase mortgages, etc., etc. The knock-on impacts are huge. So I think something has to be done. I just don't know how to square the circle. Yep. And I don't think anyone does, because if you say that the four main taxes aren't going to go up, which account for 85, 90% of your revenue that's coming in for taxes, there's no wiggle room for anywhere else. So the only other way that can do is cutting spending, which that's the other side to the coin, that we're still spending too much. The amount that we're spending has consistently exceeded the expectation. So that's where part of the gap has come from, not just weaker growth. But we saw after the financial crisis, austerity is not a popular measure, and they say cutting spending, but it is austerity by design as well. So that's the only way I can see it. Or do you have to do some crazy accounting to try and figure out how it works? So apologies, I don't have the answer. And Rachel Reeves suggested this morning that taxes might slightly have to go up in the news. So I think she's definitely hinting at it, but where it comes from and how it happens, I have absolutely no idea.
And the irony is, with such tight fiscal spending policies, she's left herself very little wiggle room as well. And the markets are saying if they breach that, what is that impact? And that's the uncertainty, isn't it? Where the markets are going, well, if Labour do breach this, where do we go from there? The irony is, fiscal policy can change, and it usually changes when there's a new Chancellor of the Exchequer, so that might be the answer.
Yeah.
Not that I'm implying.
A new Deputy Prime Minister and a new Chancellor at the same time.
Mad.
But as I was, I think this is a financial planning question, not an investment management question. So
I think
you guys,
is that called passing the buck?
yeah, exactly.
So, Chris.
Yeah, I think obviously kind of Labour and Rachel Reeves have put themselves in a bit of a corner by kind of saying we're not, going to increase taxes for working people, and what we saw last time in terms of the changes is it was a bit of a scattergun approach of tweaking rules here, this here. There was obviously the big employers NI one, which was the bulk of it, but there was nothing that was really going to move the needle as much as it needed to, especially with the black hole seemingly getting bigger and bigger. I saw a rumor of kind of, as you suggested, a bit of creative accounting, kind of by, I think it was that, by increasing income tax, but then bringing down employees' national insurance, that technically isn't raising taxes on working people, but it's a way to get an increased tax take on rent, on pension income. So will there be a bit of clever accounting like that? You often see, we're going to save 5 billion by being harder on tax evaders. Is there going to be some more airy-fairy type policies that you never really see come to fruition? There's also a lot of rumor around quite big reform that, is this an opportunity for them to say, look, our tax system is overcomplicated. There's lots of anomalies. There's things that are slowing productivity. We speak about with clients, and you see, where things where if people earn an extra £1, whether it's, losing child benefit, losing certain childcare, that, that they're effectively, it's better to earn 99,000 than it is 130,000. So, there's opportunity for I think, Labour in theory still have another 4 years. Now's better time than ever to if you're going to make big changes that actually could improve things over the longer term, it's better to do it now than just before the next election. So part of me thinks they might, as you said, pulling the kind of the rabbit out of the hat, they might come with something quite big and say, we're raising some taxes here and doing this, but bigger picture, we're really going to look to overhaul things and make some changes that in the long term will put us in a better position, because can't see her going after businesses again. You're seeing with growth, we're seeing with unemployment, businesses are at the edge, and some are already, pulling back and to go after that. Obviously, there's always rumours around pensions, and we've spoken about tax-free cash lump sums time and time again. It's one of those that it could be done. I would never say never, because it would be silly to try and say it would never happen. But again, is it going to move the needle based on probably the forecast of the tax saving of either getting rid of it or reducing it? It's not going to be enough to fill any black hole that they deem there. So, from a financial planning side, we're certainly saying don't try and second guess things. There were some big changes last year, on pensions, but on other wider areas, and there was not really anything that people were speculating that actually then came to fruition. So it can be risky to make big decisions based on speculation. So we would always say we will wait and see and plan and adapt as necessary once we know what the rules are, because you can try and second guess things and then put yourself in a worse situation based on something that never changes.
Just on that, I mean, I think that's a really important point, because not just businesses and individuals do that, but businesses will do that as well, because what's the tax environment going to be? And if people are sitting on their hands, it's the right thing to do, but it weakens growth because it stops people making decisions. And we saw this last year where economic growth dipped as we went into the budget. That's probably what's going to happen now as we get closer to that.
I think we're already feeling that. Our clients just hold them back to see what's going to happen in the next 6 weeks.
Yeah, exactly. So
I think as well, it's easy to get doom and gloom. Expectations are low in a sense, both for kind of the outlook for the UK in general. It feels the sentiment's pretty negative, and that based on the last budget, it then feels, oh, what's coming next? And it may be that, but it might be the case that things aren't as bad as expected. They might not be ideal, but they just aren't as bad as everyone expects, and that can sometimes be a catalyst enough to give a bit of positive sentiment back again. If we have a budget where you know, there aren't too many significant changes, and you know, maybe they do row back on one of their you know, we weren't going to touch this, but look, we've got no choice. And actually, if people go, well, actually, it makes sense, let's just crack on now. That could, you know, there could be some positives out of this.
And legislation's constantly changing, isn't it? Hence the need for constant rebalancing of portfolios, and hence the need for constant reviews of your financial situation for clients, volatility, to make sure that your portfolio and funds and also your financial planning actually is still in tune with the legislation that may have changed going forward. The thing that I would say in terms of, I don't know, I'm supposed to be asking the questions here.
Well, I was interested in your perspective. I'll ask you the question. What do you expect from the budget, Stuart?
I mean, personally, I think it would be easy to turn around and say, we got it wrong, we didn't realise how bad the finances were, we're going to put 1% on everyone's tax. And I think people would probably be quite happy with that as long as they can see some output. However, you mentioned before, Chris, about the national minimum wage increasing, national insurance increasing, thresholds coming down. This is an unapologetic plug. They've got the employee benefits department headed up by Joe Wan, who's working with a lot of our clients, a lot of our introducers clients, to review their employee benefits, to try to make sure they're fit for purpose, the employee benefits, but also save them money to accommodate for some of those increases for businesses. And I also think for individuals, the majority of our clients are owner managed businesses. Some of the previous budget changes, such as the value of businesses forming part of your estate for inheritance tax purposes over £1 million at 20%, pension coming in from April 2026, the agricultural property relief being changed again similarly in terms of the dates and the amount that will form part of your estate, and then pensions forming part of your estate in April 2027. I would stress to all clients, introducers listening, now is a great time to sit down before April 2026, before April 2027, and have a look at some financial planning and what we can do to mitigate those taxes. Because even although the tax position is quite onerous, as you've said, there's still a lot of allowances out there that clients and companies can take advantage of. So that'd be my view. I'm here to ask you questions, not answer. So just with regards to the budget, anything from anyone else on that?
No, I think we covered it all, really.
I would say sit tight with, you know, we don't know what's going to come. And try to tune out the noise, I would say, for the next, it's only going to get higher from here. We saw last time there was, and I think it's intentional probably from the government. They put little feelers out, see the reaction. Don't believe everything you read. Sometimes step back and understand which paper it's coming from and think, well, how do they feel generally about the political party? And again,
that won it.
You know, don't believe anything you read, I'd say would be my message.
I mean, that's one of the good things. Well, one of the things the Conservatives did very well. They leaked the whole budget a month before, and everyone knew what was coming in, so the budget wasn't a surprise.
We've had a question through.
Okay, excuse me. So there's will UK we may as well touch on this now. Will UK interest rate cuts next year impact the Gilts proposal that you mentioned before?
So as we saw in 2022, when interest rates were going up, gilt prices came down. So because they have an inverse relationship. So therefore, if interest rates are coming down, gilt prices should be going up. So that's a positive in terms of, you know, you should get some performance coming through from the gilt market. What I would say is the gilt market is forward looking now, so they're expecting interest rate cuts to come. So you've got to expect that interest rates will be cut by more than the gilt market is currently expecting for the gilt prices to increase. But I mean, the simple reason for that is if you go look at the proposal that we showed before, and you've got a 4% return on gilts. If interest rates go down to 2, then that's obviously more attractive. So what happens is the price goes up, and as the price goes up, the return on the gilts going forward comes down. So it should be a positive backdrop, but we're not. I think it's already expected a little bit within the market.
And often the gilts that we're talking about when we're looking at kind of alternatives to cash would always, you know, if that's the purpose for them, would always be very short-term gilts, which you know, things like interest rate cuts and things like that aren't going to have as much impact, because regardless of what the interest rates are, there's a certainty that if it's 6 months down the line, you're getting your pound back, the interest element isn't as important as a differentiator. So it certainly will, you know, moving forward, have an impact if generally rates come down. But yeah, you know, as Alex said, I think it's a lot of what's expected is already priced into these gilts. It's if there's a bigger change than anticipated.
And just on that, and I'll just maybe give some numbers. I mean, we looked at the prices of those gilts before. They're about 85 to 95, and they're all, as Chris said, very short term. They're all due in the next 5 years. There's a 2061 gilt. Have you seen this? It was issued, it must have been during with interest rates being low for such a long period of time. The price on that is currently 25p. So that's fallen 75% since it was issued 4 or 5 years ago because of the move in interest rates and the expectation of, so
that'll mature at my 87th birthday.
Happy birthday. But I mean, but it will be maturing at 100p. So again, if you expect interest rates to come down significantly, I'm not saying go and buy it, because this thing is like, you know, you think equities are risky, this thing's fallen 75%. But you know, that is going to mature at par at some point in the 2061.
Just had another question that you've mentioned that some of the markets are at an all-time highs, but they're not reflective in some of the clients' underlying portfolios being at an all-time high. So
yeah, let's share this then. Excuse me a second.
This was certainly a conversation I think we were having probably more back around the time of the last webinar, back in kind of July time, because you know we had seen the fall, and then the markets were around there back at all-time highs. But as Alex will show, there was a currency element which was impacting that. I think even beyond that, now at this stage, there's kind of been enough market movement despite the currency that most portfolios should be back at pretty much all-time highs or beyond it. But certainly when you factor in this, if you know, if you were sat over in the US, it might be looking a bit prettier for you.
Yeah. So I mean, thanks, Chris, for helping me out there while
you get your slides.
scrambling around.
when you prepared
Exactly. So this is the return of the dollar in sterling terms this year, and you can see it's down 9.9%. And well, why is that the case? I think one element is definitely the fact that we talked about the UK's debt problems, the US debt problems even worse, and their deficit is blowing out because of Trump's policy as well. So it's certainly had an impact there. And then the second thing is Donald Trump. There's no easy way of saying it. He's basically upset the world with the tariff announcement that's come through. As I said, it's the biggest increase in tariffs for 100 years. It's the biggest market in the world. Global trade is dependent on the US economy. And everyone is feeling the pinch, and everyone responds and reacts accordingly to that. And you've seen people selling dollars. We've already mentioned the treasuries and rebasing to go to gold and other assets. But no, that's a significant fall in the market. And then, so what we've done here is just, well, what's the S&P done this year? So the S&P, as you said, is at all-time highs. It's up nearly 15% this year. This is in dollar terms. So if you're in the US, as Chris said, you buy and it's in your local currency. But when we're buying the S&P 500 or US stock market, we're doing so from a sterling perspective. And you can see this is now converted back into sterling. You're up only 7% because of that 10% devaluation of the dollar. I think it's a really important point because over the last 15, 20 years, we've been in a dollar strength environment and a pound weak environment. You know, some of that Brexit, etc. Some of that was overvaluation going into the financial crisis. But it's kind of also not really been seen by investors. And it's almost, if you, as I kind of said, it's been a positive for your performance for holding US assets over the last 20 years because gradually sterling's gone from £1 to $2 down to what we're at today, 130. We did get down to 120. It got very low. So that's been kind of a strong return that's been driving markets. And longer term, the question is now, does this trend continue? Do people continue selling down their US assets? You know, the US stock market has performed fantastically well and dominates all global markets nowadays, and assets have been sucked into the US equity market. So just to put some numbers on that, when I started my career, the US equity market accounted for about 50% of global equity markets. It's now at 75%. And we touched on the Magnificent Seven earlier, that they are a big part of that. The US bond market is is the biggest bond market in the world, so it's sucked in capital. But as things change and people's behaviour change, does the US dollar start to come under pressure? Now, we're conscious of that when we're building portfolios, because currency risk is another risk. You've got equity market risk, economic risk, but currency risk is certainly in there as well. So we've been looking at ways to reduce currency exposure within portfolios at the moment and protect returns in case that the US goes through a prolonged period of the dollar being under pressure, which I can see happening, which is maybe the first time I've thought that as well.
So just mentioning that, this is just one of my questions. It's just come to light when you're talking there, Alex. Bitcoin's becoming more mainstream. I'm not going to say steadier, but more and more people are looking at it. You mentioned about the dollar maybe not being as strong going forward and people using that as a safe haven to rebalance their currency against. Do you think there's a place for Bitcoin in terms of investing? I know you don't hold it in any of your...
We haven't been able to hold it because the FCA has said that these products aren't eligible and we don't have the permissions to be able to hold it. But that is currently changing. So the FCA are allowing ETFs linked to Bitcoin cryptocurrencies to be allowable investments going forward. It's something that has to be discussed because it's a bit like gold, but it's a much more higher volatile version of gold. I don't think we're there yet. I think regulation coming through helps. It happened in the US, it's now happening in the UK, and that kind of accepts it as a global asset more and more. But it's still not recognised by central banks, etc. Will it ever be? I'm not sure. It's something that will always, will be an action point and discussion point on our investment committee because it's an investment. But the thing that scares me is just the volatility. We're here to deliver strong compound returns. A cautious investor, maybe 4 or 5%, an equity investor at 8 to 10%, hopefully. Bitcoin could be up 1,000% or down 75% in any particular time period. And that's, difficult to deliver those investment goals when you've got that level of volatility coming from part of the portfolio.
I think the other element to it, Bitcoin's been around for 15 years or so, would it be?
Yeah.
Just after the financial crisis. And, that sounds a long time, but in investing markets, in terms of looking back at historical evidence, 15 years isn't a long time. And, equity markets go back over 100 years and you can then have fair confidence that it's,
how they perform in different environments, inflation, interest rates, recession, growth,
And you'd argue that actually the point since Bitcoin started has been probably up until about 2022 was a very particular environment, and we've had a slightly different one now, but we've not seen world wars to the degree, there's lots of things we've not seen and therefore seen how that might react. I think it, as you say, it certainly comes up more in conversation, but as Alex highlighted, right at this moment in time, it can't be accessed in a regulated way, but that will be changing, I'm sure, and I'm sure the talk around it from clients will increase too.
That maybe for the next webinar. Well, first of all, again, thank you to you both for your time and your knowledge and your insights into the markets. A couple of key takeaways that I would suggest. We continue to see resilience across the markets, despite uncertainties, which we've touched on, geopolitical in relation to trade and political tensions. Performance remains strong year to date. Risks remain low, volatility remains, which highlights the importance of a well-diversified portfolio and also a portfolio that reflects your risk and volatility. So please, I would encourage all of our clients to make sure that they review risk and volatility on a regular basis. And something we touched on right at the very start, and Chris, you mentioned it as well, I think it's important that we look through a lot of the noise, focus on the long-term goals, not the short-term reactions, and focus on those fundamentals of companies in the stock markets and investments, and focus on the fundamentals of your own portfolio and what your needs, priorities and objectives are. So thank you again for everyone that's dialed in. The next webinar will be in the new year. I'm not going to start wishing people a Merry Christmas just yet, but the Christmas markets are open on the 7th of November.
7th of November.
7th of November, and they're in this, they're going to be in Albert Square again, which is
Okay.
moving back. So if anyone's around, I'm sure I'll bump into you on a Friday afternoon. If there's anything any of our listeners, clients, introducers would like us to cover in any future webinars, please reach out to myself or Pareto Marketing. Feel free to speak to your advisor on any issues that may have cropped up in the webinar or you're worried about. Feel free to come via ourselves if there's anything you'd like to discuss with Luna. And it just allows us to say thank you for dialing in, and I wish everyone a good day.
Thank you very much. Thanks for having us.
Thank you.
Thank you.